Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 28th day of May, 2019. And always like to remind you that I'm the author of Jay Taylor's Gold, Energy, and Tech Stocks. Sign up for that by going to miningstocks.com. I'd like to encourage you to consider signing up for Chen's newsletter, What is Chen Buying, What is Chen Selling? Go to chenpicks.com for that. And also Michael Oliver, it's olivermsa.com. We'll be talking to Mike in just a few minutes from now. And I do want to thank all of you for listening to this show, and please send along your comments, questions, or whatever you have, thoughts you have about this show. Send them along to questionsfortaylor@gmail.com. I also want to thank our sponsors for making this show economically viable. For today's show, our sponsors are Klondike Gold, Novo Resources, RN Resources, and Strike Point Gold. Now, before we get started with today's show, I would like to advise you that that both Novo Resources and Klondike Gold, the two of the sponsors I just noted, released two very important news releases today. Novo Resources talked about its mineralization report from its Karatha project and how it is planning to proceed with its exploration program there over the next few months. And Dr. Quentin Henning will be with me during the second segment of today's show, and I'm sure he'll talk more about the press release today as well as the three projects that the company is working on in Australia. And Peter Tallman's Klondike Gold announced today that it's beginning to drill at on the Klondike property. Now, this is particularly exciting to me because, as you heard last week, if you listened to Peter last week, Klondike now believes that they have discovered the structural controls where the high-grade gold exists, located in their 563 square kilometer property in the Yukon. And, they've been finding a lot of lower-grade disseminated gold mineralization, which is very important from a longer-term perspective. But what really gets the stock investors excited in these junior gold stocks are some high-grade hits. Peter said, and I quote, "Our press release is in time for your show today." He sent me this email, and he said, "Our press release is in time for your show today. We have started drilling at Gay Gulch and El Dorado Fault." Now, you haven't heard much about El Dorado Fault, unlike the Parallel Nugget Fault and the Bonanza Fault where Lone Star is. Hopefully, with this drill program and some related surface investigations, we will start talking about it more. It won't take long to complete the short 7-hole program. Some of these holes can be drilled in a 12-hour shift. And so I'm suggesting that any of you who own this stock might want to keep a close eye on what happens. We should start getting some drill results very soon, and I believe that they are targeting these high-grade intercepts where the management now believes they have figured out where the structural controls are. So that's very exciting. But speaking of high-grade results, now just hot off the press, Great Bear, who has been a sponsor of this show up until a week or so ago, he just came out with some really exciting news on its Red Lake property, specifically 12.33 grams of gold per ton over 14 meters, including 30.9 grams per ton over 4.6 meters, and 194.21 grams of gold over 2 meters. And that includes 759.38 grams of gold over a half a meter in multiple shallow gold zones at a brand new discovery that they just made at Great Bear. And I'm looking at the stock. It just started trading shortly before we went on the air, and it is up about, it's up 36 cents today. That's a 16% rise on the information. Very exciting news. So I expect hopefully we'll have Chris Taylor on the show sometime in the near future. But these are really exciting numbers. It's a really exciting industry when you start hitting some good high-grade results. Anyway, today's show I've titled "The Dollar is a U.S. Problem." Dan Oliver, Dr. Quentin Henning, and Michael Oliver return as guests. The dollar system was founded at Bretton Woods and rests on three pillars: American military supremacy, American financial hegemony, and American economic prowess. Russia and China are challenging America's military power, and a new Eastern trading bloc and the euro are challenging America's financial hegemony, and America's debt problem is challenging its economic prowess. So those are topics that I'll be talking to Dan Oliver about during the second half of today's show. And I want to ask Don to discuss each of these threats to the American prosperity and provide a prediction of what those threats might mean to the dollar hegemony and, by extension, of course, to the price of gold. And as I just noted, Dr. Henning will be with me in the second segment of today's show, Dr. Quinton Henning, and he'll give us an update on what Novo is doing. Very exciting news. Now, not as exciting as when they first made those great discoveries, those gold nuggets, but the work is continuing, and I think longer term, this still remains one of my top picks and one of my, I think, most exciting stories that we're covering among a growing list of exciting stories. But right now we have Michael Oliver with us, and thank you for joining me again, Michael.
Hi, Jay. Good to be back.
Good to have you with us, as always, and it's good to tell our listeners it's olivermsa.com, olivermsa.com, to learn more about Michael's work, and specifically if you're interested in the precious metals, he has a lower-priced, very useful service that keeps you abreast of the precious metals. Michael, you have been saying and have been saying for some time that you think that we need to see the equity markets get weaker before we're going to see any kind of meaningful rise in the price of gold. Could you explain? I mean, that hasn't always been true. Sometimes they run in unison, but right now you're suggesting that they're going in opposite directions generally. They're not linked in positive correlation any longer.
I think that's the case. I think the divorce occurred in 2011, and it was prior to that they were in sync. Gold was on the upside, would lead the S&P in terms of percent gains during those years from 2000 to 2011. But the basic large surges and drops were fairly coincident. Gold, for example, collapsed into late 2008, where the S&P peaked in late 2007, but started its collapse in the latter part, summer and fall of 2008. Gold joined in at that point, and it collapsed as well. They both turned in early 2009 from their lows. And gold went from it was $680 and went to $1920 between that 2009 low and late 2011. During that same time, the S&P advanced, but nowhere near as much. But they were in sync. But then in late 2011, the S&P was making a sell-off low after the European debt crisis. Remember, in the summer of 2011, you had a big hit in the S&P and the German index and so forth. And it made a low, and the central banks went crazy at that point in terms of policy, and that drove the developed market indices up big time. At that point, gold divorced and went down. It topped in 11, collapsed in late 2012, early 13. At that point, it's totally opposite now. So the people who are still focused on issues like, well, if the S&P collapses, won't gold collapse? Yeah, that was true in 2008, but since then, their major moves have been opposite. In fact, if you just go back over the last year or so, even some of the moderate and minor moves in terms of peaks and troughs are inverse. Some of them pretty good inverse, some of them almost precisely. Just a recent example, for example, we had the run-up in gold 2 weeks ago, and it spiked up over 1,300. May 13th, Monday morning. That was the same time the S&P made its low for this move at 2801, almost within hours, inverse. And the S&P since then bounced sharply, rallied about 3% after that 2801 low over the next week or so. And gold did what? Backed off about 3% from the 1302 high close that it had in May 13th. And since then, gold's gone into congestion zone between the highs and lows. And what's the S&P done? Gone into congestion between that high and the lows. So we're getting very similar action in this case, even pinned down to the day. So I think the people who are worried about a major stock market drop, which we think is going to happen, it will be the opposite this time. I think you're bringing investors into gold, and you can see it when the S&P gets whacked. Not necessarily to the hour like it was Monday a few weeks ago, but the inverse relationship is good. Now, also look back, for example, S&P made its second of its three peaks back in August, September of last year, prior to that late 2018 collapse. You went from a high at 2940 all the way down to 2350 in the latter part of the year. But as the S&P was making that marginal new high above the January 2018 high, doing it in August, September of 2018, what was gold doing? Making a low around 1160. What happened between then? Gold ground its way up and then finally shot up with real strength late in 2018 December was quite a month. And what happened to the S&P? It arm wrestled its way down and then collapsed into December 2018. Now, what's really interesting, though, is this. It's not just the inverse relationship, but lately, and I think this is evidence of investor shift, regardless of S&P's rally. It doesn't impress them. For example, why is not gold back down near the August 2018 low at 1160?
Yeah.
After all, S&P went up and marginally nipped out the high of that time period. So if gold were equally as weak as the S&P was strong, it would be back down there. So instead, since that August low of last year in gold went from about 39.8% of the price level of the S&P. It's now over 45% of the price level of the S&P. So despite all the noise and the opposite zigzags, gold has gained ground relative to the S&P since that low. Despite the fact that S&P went to a new high, it still offset that. Yeah. So it shows that even though the S&P went up again to a marginal new high, which it failed at, the money did not flee gold market. Some of it backed out, but you don't hit a moderate pullback. So that indicates to me some resolute nature of investor buying in gold. The hand is firmer than it was back in August of last year.
Sure.
So
well, Michael,
going forward, in other words, go ahead.
No, you go ahead. Go ahead.
No, but going forward, I think gold investors need to be aware of that fact that we are in the divorce situation versus the developed market stock indices, and not to fear the issue of a repetition of the late 2008 collapse in the stock market in which gold participated. I think it's exact opposite now. If anything, an S&P collapse will further encourage investors moving across the line into the gold market.
Right. Well, Michael, what about the Treasury? Obviously, most of the money flows into the Treasuries when it comes out of the equities, right? So it's risk off, it goes to Treasuries. Maybe a bit of it goes to gold, as you're suggesting. But, what do you see going forward? Do you still see that for the Treasuries? Do you see Treasury rates coming down a lot? Or what are your...
they'll benefit. And right now, they're quite strong, by the way. They're making new highs for this recent move.
Yes.
So the Treasury sense something fairly immediate on the horizon, I think. And I don't think it's some long-term interest rate situation here when you're dealing with the 30-year and the 10-year. I think the move there is, in fact, a flight to safety. And therefore, the question is, why is the money flowing so resolutely and suddenly now into the Treasury market over the last few weeks while the S&P is congested after its recent drop? I think the T-bond sense that recent congestion in the S&P is not going to prevail. And that, a few weeks from now, the S&P might not be anywhere around where it is right now.
Right. Right. So that should provide some wind at the back of the gold investors and gold share people as well, I would think, and probably the Treasury markets. But how much lower can these rates go, for goodness sakes?
No, I think that, it could be a spike in the T-bonds if the S&P breaks. And, speed is the issue. It's not a slow S&P decline, but a rapid one is what engenders that flight to quality stuff. I do suspect, and I don't want to emphasize it too much, I think if the S&P does snap rapidly sometime in the next few weeks, and we have a suspicion that could happen, that the move in gold will also be rapid. So it'll be opposite, but also of the same tenor and tone, but reversed of the S&P, as there are very few places on the planet to put money. Developed market stock indices are not working well. Japan, Europe. Our market's working better than theirs, so we've attracted a lot of foreign capital into the U.S. stock market. But it's a loaded boat right now, the U.S. stock market. It's loaded with foreign capital, and I think once that money starts to flow out, it's also going to whack the dollar. The dollar is somewhat in sync with the S&P now, by the way, in our view. And also the dollar is an issue that a lot of gold people look at and say, well, gee, the dollar is so strong, how can gold be up? Well, that's a good question, isn't it?
Yeah.
The dollar has, since last August, if you use the dollar as your reference point, whether to buy or not buy gold, you wouldn't have bought gold because the dollar has remained steady to firm. It's gained, 1% since August 2018 high. It was a rally high in the dollar when gold was making it slow. But the dollar held in there, whereas gold rallied 10%. With no help from a weak dollar. Yeah. In fact, right now the dollar is 1% higher than it was 10 months ago, which is trivial, but it's still higher. And yet gold is now, not 1160 something, it's 1280.
Yes.
So you
things are looking up.
Move
things are looking up for the gold bucks.
Huh?
Things are looking. We've had a lot of people very concerned because gold's going nowhere, Michael. But it seems to me that the sun is about to shine on the gold markets, and people shouldn't be in despair.
No, I fully agree, and I also think that if it's going through the mid-1300s, which we think so, and that's a very clear level for the price folks, they'll get excited when you do that. I think it'll be suddenly. I don't think it'll be an erosional rally. I think it'll be a thunderbolt. And it probably might be reflective of the opposite for the S&P.